You're listening to Capital Topics, episode number 79. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss expected returns with Raymond Kerzérho, PWL's senior researcher. Enjoy! Hello, James. How are you today?
I'm great, François. It's the middle of the summer. The weather's been beautiful, and I'm back from vacation. So thank you for asking.
Yeah, welcome back. So, as I mentioned in my introduction, to help us tackle today's topic, we have invited Raymond Kerzérho, PWL's senior researcher. So, good morning, Ray. It's good to have you back on the podcast.
Good morning, guys. Glad to be here.
Okay. So, Ray, you have recently published an updated version of your financial planning assumption for market capitalization weighted portfolio. But before we dig into the details of the report, can you give our listeners a brief introduction to this report and what it's intended use for?
Sure, absolutely. So the report provides projections for a bunch of variables that are critical for investors, such as long-term projections for inflation, return, and volatility of asset classes. This is the data that our financial planners use to make their retirement projections. So this is quite essential material for our firm and for our clients. And so there is important nuances here, though. These projections are projections. That's why they're called like that. They're not predictions.
Yeah.
And we recognize that we have a substantial margin of error in our numbers.
Yeah, that's a big nuance. So, but right now, your numbers, you update your numbers twice a year. You've been producing this research for over 10 years now. Can you update us on your latest expected return estimates? And are there any material changes compared to your most recent reports?
Yeah, sure. So to start up, the numbers are very similar to what we had in last January when we released the previous version of this paper. So jumping into that, so our first projection is we see long-term inflation at 2.5%. The nominal returns, I talk in nominal terms, so it's much easier for the listeners to visualize that.
Right.
So we see bond long-term returns at 3.5%, Canadian stocks at 7%, the U.S. stock market, we see it at 6.5%, and then international stocks at 7.3%. So if we combine Canadian, U.S., and international global stocks into the global market, we have an overall expected return for this global asset class of 7%. And if I look at all these numbers on a real term basis, it's going to be a 1.5% expected return for bonds, net of inflation, and 4.5% for global stocks.
So real returns is net of inflation, after inflation.
Ray, can you now please explain the methodology you use to calculate these expected return estimates? I understand from the report that you use a blend of market-based expected returns and it's a little bit of a jargon here, equilibrium cost of capital. But can you please elaborate on this and how these two models complement each other?
Yeah, so none of these two methods is perfect. So to start with market-based expected returns, these are essentially what they say. It's that based on indicators that we can observe in the market. And the equilibrium cost of capital is just a fancy way of describing historical returns. But you can't make money out trading based on these market-based expected returns.
Ray, you use a hybrid approach to estimate expected returns. You combine these market-based expected returns and equilibrium cost of capital. You believe this is more robust than relying solely on long-term historical performances to estimate future expected returns. That's an important point that you make in the report. Can you explain for our listeners a little bit further?
Yes. So as I mentioned before, none of these two methods is perfect. So ideally, we would use only the market-based expected returns because we want our assumption to be adapted to the market conditions. And so how do they work? If asset prices go up, generally expected returns go down. And conversely, if prices drop, expected returns go up. However, we have done some statistical tests on these market-based estimates, and we found that these estimates work really well for bonds. They're not perfect, but they work well. And for stocks, they have some predictive value, but they don't work nearly as well as they work for bonds. So basically, we put a heavy weight on market-based for bonds, and the balance we put into the equilibrium cost of capital. And for stocks, we do exactly the reverse. We put a light weight on the market-based expected returns, and we put the balance a more heavy weight towards the equilibrium cost of capital for stocks.
Yeah, that's interesting, Ray. But how did you calculate the market expected return and the equilibrium cost of capital?
So market-based expected returns are calculated with the yield to maturity for bonds. All right. And the earnings to price ratio for stocks. So the earnings to price ratio kind of provides us with a sort of interest rate, if you will, for stocks, looking forward interest rate.
Right.
Note that the expected return based on market fluctuates inversely to prices, like we've discussed before. So if stock and bonds price increase, expected returns decrease, and vice versa. Equilibrium cost of capital then is based on inflation-adjusted historical returns since 1900. Like on the podcast, you refer regularly to the Dimson, Marsh, and Stoughton study. So these authors publish historical returns dating back to 125 years.
Yeah, Ray, if I may add, that's when we do our podcasts about the UBS Global Asset Returns, a report that they publish annually. Well, it used to be published by Credit Suisse. So most of our listeners would know it as, the Credit Suisse or the UBS report.
Yeah.
So a last note about our methodology. So I should add that we make adjustments to the equilibrium cost of capital for stocks. So we don't take the historical return as is. We subtract an element from the expected return to take account from the fact that stocks are much more expensive nowadays than they were at the beginning of their data history. So we make an adjustment for that. So instead of having, like, if you look at the DMS return data, you would have a 5.2% for global stocks historically over the last 125 years. We subtract 0.7% of that to account for what we call the multiple expansion of the global stock market.
Yeah, so for listeners, for more details, you can consult the Ray's report. We'll make it available with the link with this podcast.
Okay, now Ray, you've provided us with expected returns for each asset class that we use in building our portfolios. Can you tell us what your expected return is for a classic balanced portfolio, which is 60% in stocks and 40% in bonds? And then can you also tell us what the breakdown of your allocation of stocks is?
Yeah, absolutely. So for our expected return on a balanced portfolio, we've got like 5.75%. That's nominal. Once again, I need to specify.
Yeah.
And our global stock portfolio allocates about 1/3 to Canadian stocks, and the balance is 44% US and 22% international stocks.
But how did you come up with this allocation, Ray?
Yeah, so the stock
stocks.
portfolio, pardon me?
To your stock portfolio.
Yeah, the stock portfolio. The stock portfolio mimics the weights of the dimensional global equity fund, and the way they manage the fund is 1/3 Canadian stocks, and the balance is allocated based on market cap weights. So
Okay.
it's a large allocation to U.S. stocks, but that's the truth. It's like the U.S. stock market represents almost 2/3 of the global markets currently.
Yeah, that's the way we view things also in our portfolio, except we've got lower weight in Canadian stocks. Instead of 1/3, it's 20%, and the rest is global market cap weights. So 2/3 about to US and 1/3 to international equities. Now, Ray, can you explain why the expected returns on Canadian and international equities are higher than for the US? Also, since these expected returns are higher, should our listeners tilt their portfolios away from the US or at least reduce their exposure to US equities?
Yeah, well, I'll take the question in reverse. It's actually the US stock market that is expensive, and that's the reason why we put a slightly lower expected return on this asset class. It's as simple as that. So if you look at Canadian and international stock markets, the prices are much more reasonable than they are in the US. So that's one thing.
Ray, may I say, well, US equity have done so well in the last 10 years that expected returns for the future makes sense that they're lower.
Exactly. When prices go up, expected returns go down.
Right.
But we were never sure to what extent, and we never know how long it will take to correct or in some ways.
Mm-hmm.
So there's your other question that is quite important here is should we tilt away from U.S. stocks? And I mentioned earlier that you shouldn't use expected returns to trade. This is not a good trading strategy. Mm-hmm. If I look at our history, like I've been measuring expected returns for PWL for over 20 years, and the U.S. market has been more expensive than international markets since then. So we would have lost a lot of returns if we underweighted the U.S. stock market during that whole period. So as I mentioned, expected returns, they're not really precise. The idea is to supply data for planning assumptions and for financial planning. And the other idea is you don't need them to be exact. You need to be in the right ballpark in order to provide good financial planning to clients.
Yeah. Okay.
Raymond, to this point about U.S. stock valuations, I mean, that was really the core of our topic in our most recent podcast, number 78. So I recommend for the listeners who haven't had a chance to listen to it, to go back to it, to get our view on U.S. equity allocation. Ray, I would like you now to talk about your report on expected returns for factor tilt portfolios. And can you explain what factor tilt portfolios means and how it's different from market-based?
So yes, a factor tilt portfolio invests in a very diverse group of stocks, but it overweights stocks with higher expected returns. The variables associated with higher expected returns are small capitalization and value stocks. PWL invests partly with dimensional funds, which are managed with a factor tilt strategy. Some of our portfolio managers invest exclusively with dimensional funds, so they require a different set of assumptions to account for the higher expected returns and different risk characteristics associated with these funds.
That's interesting. But how much return can investor expect when tilting their portfolios towards the value in small cap stocks? And is it a worthwhile exercise given the added volatility and tracking error an investor may experience versus the main broad market indices?
So for the first part of your question, for an all-stock portfolio, factors can add up to 0.45% to the long-term return.
And that's for an all-stock portfolio?
That's for, global stock portfolio.
Okay, yeah.
And for a 60-40, the difference is 0.2%.
If I may interrupt, Ray, that may not sound like a lot of return differential for our listeners, but when you compound that over long periods, like 20 years, it really adds up as an extra return.
Yeah, and at least it covers the fees, most of the fees out of the ETF and the tools you use to build the portfolios.
Correct.
Yeah. To continue, really, whether it's worthwhile adding factors depends a lot on investors' tolerance for periods of underperformance. The advantage of factor-based portfolios is not only that it offers a higher expected return, but they also offer an effect of diversification because the factors don't correlate much with the market. So in some events, some periods you'll have maybe lower stock market periods, then the factors are going to work well in these periods. It's not guaranteed, but the low correlation add an element of stabilizing the returns over the long run. So in my opinion, factor-based portfolios are better diversified. However, if an investors tend to feel frustrated when their portfolio underperforms the indexes, I would instead recommend a passive market weight ETF portfolio, and they will just do fine with that portfolio.
So, Ray, I think your point about you got to tolerate underperformance, as we've discussed in our podcast, growth in the U.S. market specifically outperformed value massively for 15 years, ending in December 31st, 2024. So tolerating underperformance can be quite a long time and can test investors' patience. That said, points you make are very important, and our listeners should really take heed. In your report, Ray, you provide nominal returns, that is before inflation. And as we've discussed often in our podcasts, you really have to look at the real returns, particularly when we look at Professor Cederberg's research about being 100% invested in equities versus in bonds, where he says, wait a minute, if you look at the real returns, it's not worth it to be allocated in bonds, for the long term for most investors. But again, it depends on your risk tolerance. So again, we think it's really important to look at real returns, that is the returns after inflation. So can you explain for our listeners the importance of measuring returns after inflation?
Yeah, of course. It's quite simple. First, I would like to mention, I think we've discussed that earlier, but we do have an inflation assumption in addition to the nominal returns we put in the report, so that the financial planners can do their own calculation to come up with real returns. So our assumption is once again 2.5%. About the usefulness of real returns, that's absolutely true. Financial planning is centered around actually wealth creation. If you obtain a 7% return on your portfolio, but it's all offset by inflation, you're not making any progress. So it's really real returns that matter to financial planning, not nominal returns.
Ray, your report also looks at the expected real return of owning a residence. I think that's a very interesting aspect of your report, since most people have a lot of money tied up in their primary residence. However, I think our listeners will be surprised and find your estimated expected real return low given the big increases in house prices of the last decade. Can you please explain your findings?
Yes, so we assume a long-term real price appreciation of 1% on personal residence, and this assumption does not account for the cost related to home ownership, such as taxes, insurance, and maintenance. When compared to stocks over the long term, housing does not compare well. In the last 20 years, the data shows that Canadian housing real returns have performed much better than our 1% assumption. But that's the exception rather than the rule. Economists such as Nobel laureate Robert Shiller have done a ton of research on housing, and they mostly conclude that real returns are actually low. It's fine to own your home, but my recommendation would be it's really a lifestyle choice. It's not really an investment strategy. People are impressed because when they sell their home after several years, they often pocket multiple times their original purchase. I have a personal story here. When my dad passed away, we sold our family home for 12 times the initial price. And I actually calculated the return, and net of inflation, the return was not very high. It was really low.
What was it, Ray? What was the return?
Net of inflation, I've got 2.5%.
Wow, it's incredible. But you owned it for a long time because 12 times the one.
35 years.
Yeah, the normal human being doesn't understand compound interest mentally, and it's really the compounding effect that creates that.
And that's probably just on the price. There was maintenance, taxes, and all of that during that period as well.
Yeah, like my parents were very, very, how would I say that? They managed their finance very tightly, so they didn't do any big renovation and stuff like that. When we sold, we had the original kitchen that dated back to 1958.
Okay.
But they've redone the roof 2-3 times. They changed all the windows, all that good stuff. It cost a lot. So it seems like a good investment, but when you start doing the math, it's not all great. I'm sure some people there is exception to that, but in general, it's not an investment that is nearly as profitable as investing in the stock market.
Interesting.
Ray, last year in August, you published a blog entitled "What Should We Expect from Expected Return?" Sort of a play on words. But in that blog, what you did is you compared the estimates in your report with those produced by major investment firms with global scope, BlackRock, AQR, Vanguard. Can you tell us how PWL's estimates compared to those other firms?
Sure. So maybe your listeners have heard my numbers earlier, so maybe they have thought that, oh man, they're so conservative, it's not going to happen, the real returns are going to be higher or what have you.
Yep.
And in this comparison, I'll just take global stocks just to minimize the number of numbers I'm gonna cite here. But on global stocks, for most of these firms were 0.1 to 0.2% below us. So we were above the big firms. And for bonds, we were about 0.5% above the big firms. So overall, listeners may think that we were very conservative in our expected returns, but assumptions. But in reality, we're a bit more optimistic than some of the major investment firms.
Yeah. Yeah, this leads me to a final question here, Ray. I've recently looked at the result of a survey from Natixis Investment Management, which is a French multinational financial services firm, which conduct a biannual survey of about 7,000 individuals with at least $100,000 in investable assets. And from this survey, it looks like investor return expectations are much higher than the expected returns produced by PWL and the other firms we've just mentioned a minute ago. To give some context to our listeners, Natixis survey highlights that investors globally are expecting an average return of 10.7% on their investments. In the US, investors are expecting an even higher number of 12.6%. Now, can you rationalize these high return expectations, and what do you see as being the biggest risk for those investors who plan their retirement based on such high expectations?
Ray, I would like to, just before you answer, like François, the Natixis report states that the expected return of 10.7% is after inflation. So if you look at our nominal, return for global equities and you add in the inflation assumption, I mean, the spread is huge.
Yeah.
Yeah. I had the same reaction as you, James. Really, when I read the report, I was shocked, especially by the fact that 10.7% is a real expected return. It's really high. Personally, I think that's nonsense. However, we must understand that non-professionals, it's normal that they overestimate returns because estimating expected returns, it's a complicated task. I've put many years on doing that for our firm. Exactly. So it's normal that people don't have necessarily the right expectations. And particularly, I'm sure that PWL clients are way better educated about return expectations since we do the financial planning for most of them. So this survey really highlights the value of a podcast like this. So it's really, I think it's really a good information to start with the right assumptions, if possible. And for listeners, your advisor's job is really to educate you. That's really part of his job, to educate you about what kind of return you can expect from your portfolio. If your advisors don't do that, for me, I would consider a change. Now, the second part of your question, François, there's many dangers of having unrealistically high expectations. So I'll cite just three. First, you may save less than you really need to expect to prepare for your retirement or any other financial objective.
Right.
The second risk is you may get frustrated if your portfolio does not perform as well as you expected, and you may give up your strategy as a result. And a third risk that I see is that you may be blinded by your expectations and take too much risk. So that's another thing here I would be aware of.
Yeah. James, since you're constantly in front of clients and have been for over 25 years, do you have any final comments in regard to this Natixis survey and the type of returns that investors think they will be getting from their investments?
Well, François, like Ray just mentioned, it's our job to educate our clients about expected returns and volatilities that are associated with the investment plan we implement for them in terms of their long-term asset mix. So in reading this year's report, I have to say the Natixis report I'm referring to now, I'm really not surprised. I mean, it's been since 2017 that the report's highlighting these big gaps between, what investors' expectations are and professional managers. Our regular listeners know from our podcast where we review, the UBS Global Investment Returns Yearbook, which used to be Credit Suisse before the merger, and that uses Professors Dimson, Marsh, and Staunton's data. We look at 125 years of capital market history. So again, the key thing investors need to keep in mind is that you've got to factor in the math of negative years. And if we just look at 2022, where we had negative returns, let's say -6 to -9 with portfolios, let's say as a range, well, it took 2 years before you get back to square one. The year you lost went down, plus the positive return in 2023. So it's really the 2024 gains where you came back on track. But that negative year, and there was another one in the series in the 10 years ending in 2024, 2 negative years in 10 turn the compound 10-year returns into single-digit returns, despite many years, including the most recent ones, where we had huge returns in double digits. So that's, I think, a key message that I would retain for our listeners. The other thing that surprises me is, as we mentioned, investors' expectations are high, but the Natixis report shares the institutional managers. And these guys should know better, because their expected returns, even though significantly lower than investors, are themselves too high, in my opinion. And we go back to the research like Raymond did in his blog comparing Vanguard, BlackRock, and AQR. We, in our report, we've sourced an American actuarial firm who produces a report that looks at 40 different managers, and our expected returns are consistent with what all these, the averages of all these 40 firms. So again, I'm kind of surprised at the institutional manager numbers. The other point the final comment I would like to add is that investors must stick to their investment plan with a long-term mindset, regardless if their short-term returns disappoint them, and especially if they have unrealistic expectations. So if they're expecting these ultra-high returns and they get something significantly less. So again, expected returns, as Ray said at the outset, it's not the likely return you're going to get in an average year, but if you look over 10 years, then it'll be pretty close to what those expected returns are. That's what I have to share, François.
All right, so we'll conclude on this. So thank you, Ray, for your participation today. And as usual, it was very, very interesting. And I hope our listeners find it interesting as well. So thank you, Ray.
Thank you, François. It was great to talk to you guys.
Okay, so I remind our listener that Raymond's paper on expected returns can be found on Peter Capital's website in the Learn section. Also, thank you to you, James, for your contribution again today.
My pleasure, François.
So that's it for episode number 79 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on October 1st. In the meantime, make sure to consult the Capital Topics website for latest blog posts. See you soon, and thank you.